So, you always hear about the US dollar on the news, right? Is it strong? Is it weak? But what does that actually mean for the real world? Well, it turns out this one currency is kind of like the first domino in a massive chain reaction that literally shapes our world. And that's what we're going to explore, the dollar's domino effect. Right at the heart of everything we're talking about is, of course, the US dollar. But you've got to think of it as more than just money. It's really the language of global trade and finance. And because it plays this huge central role, the dollar basically acts as the planet's economic rhythm section. Think about it. A decision made by the US Federal Reserve in Washington, that doesn't just stay in the US. Nope. It ripples out, setting the beat for the entire world economy. So how on earth does that actually work?
Yeah, that's the big question, isn't it? How do those ripples travel all the way from a central bank meeting to the price of the raw materials inside your phone? And even crazier, how can they sometimes build up into a wave that causes a full-blown economic crisis for an entire country? Okay, let's break it down. All right, first up, the first ripple. This is the most direct impact, and it's all about the building blocks of our economy, raw materials, or what we call commodities.
This is wild. What you're looking at here is a powerful, almost mirror image relationship. And it works like this. Most big commodities, like oil and copper, they're priced in US dollars globally. So when the dollar gets stronger against other currencies, it suddenly takes more of, say, your local currency to buy the same amount of copper. Naturally, demand goes down and prices tend to fall. And when the dollar gets weaker, you guessed it, the exact opposite happens.
So why should you care about this weird relationship with copper? Well, because copper is basically the metal of the future. I mean, look at this. The big shift to green energy, it is incredibly copper hungry. An electric car needs about 3 times more copper than a regular gas-powered one. So here's the catch. A strong dollar might make copper cheaper for a moment, but it also makes it a lot harder for companies to finance and build the new mines we desperately need to meet all this future demand.
Now, silver is even trickier. It's kind of got a split personality. As you can see, more than half of its demand is industrial. I mean, it's in everything from solar panels to the data centers that run AI. But, and this is the other half of the story, it's also seen as a safe haven investment, a bit like gold. This means its price is constantly being pulled in 2 different directions, by real-world industrial demand and by the financial world's mood swings.
Okay, so let's follow the chain to the next domino. A shifting dollar doesn't just mess with raw material prices. Nope, it directly hits the price of almost everything a country imports. And that leads us straight to the big one, inflation. The key idea here is something called exchange rate pass-through. I know, it sounds a bit technical, but it's actually a pretty simple idea. It's just a way of measuring how much prices go up for you and me when our local currency gets weaker against the dollar.
So here's how that plays out step by step. First, your country's currency weakens. All of a sudden, that phone or that car part that's priced in dollars costs the local importer way more. So what does that importer do? Well, eventually they pass through that higher cost to you, the consumer. And just like that, prices for a whole lot of things start to climb.
But, and this is absolutely crucial, this effect is not the same everywhere. Not even close. In countries with really stable, credible central banks, maybe only about 1/3 of that currency drop actually turns into higher prices for consumers. But in countries where people don't really trust their economic institutions, that number can skyrocket to 90%. 90! That's how you get runaway inflation.
And this brings us to the third ripple, which is often the most dangerous one. This is where currency swings crash into debt, and it can create a devastating trap, especially for developing nations.
The whole problem really starts with this idea economists have called original sin. And what it means is that when most developing countries need to borrow big money on the world stage, they just can't do it in their own currency. Nobody will lend it to them, so they're forced to borrow in a currency that's seen as safer and more stable, US dollars.
And the scale of this is just immense. I mean, look at that number. Over 80% of the external debt held by emerging markets is in a foreign currency, and that's mostly dollars. This creates a gigantic vulnerability. Think about it. They're earning their money in their own local currency, but they have to pay back their massive loans in dollars. So when their currency falls, their income stays the same, but the size of their debt just explodes overnight.
To see how these 3 ripples can combine and turn into an absolute tidal wave of economic destruction, we really only need to look at one tragic recent example: Venezuela.
You see, Venezuela was the textbook case of this kind of vulnerability. Their entire economy was built on one thing: oil exports. That was their only real source of dollar income.
and the government was funding these huge social programs that depended on oil prices staying high. And to fill in the gaps, they were borrowing, heavily in US dollars. So what happened? In 2014, oil prices collapsed. That was the first domino. Suddenly, Venezuela's dollar income just vanished. But its dollar debts? Oh, those didn't go anywhere. The government's response was to just print tons of money, which kicked off that second ripple we talked about, hyperinflation. It completely destroyed the local currency, which ironically forced the country to unofficially adopt the US dollar, the very currency at the root of the whole crisis.
Okay, so let's pull back and look at the big picture. We've seen the whole chain reaction, from commodities to inflation to debt. Now, why does understanding this whole system matter for all of us, no matter where we live?
Well, the thing is, the dollar is really a double-edged sword. And as this table makes pretty clear, there are no easy answers here. A strong dollar, it can absolutely crush emerging markets with debt, but at the same time, it helps keep commodity prices in check for everyone else. A weak dollar might bring some relief to those indebted countries, but it also risks fueling global inflation. And just look at the energy transition. A strong dollar actually makes it harder and more expensive for developing nations to finance the very green projects the entire world needs. It's a true global dilemma.
So here's the bottom line. The dollar's dominance creates a kind of stable system for global trade, and that's a good thing. That's the benefit. But that stability comes at a real cost, a cost of volatility and risk that is definitely not shared equally. The system connects us all, for sure, but it forces us to ask a really tough question. When those dominoes start to fall, who really bears the cost of that connection?